Today with me is Charles-Henry Monchau. He is Chief Investment Officer at Bank This, and I'm very glad that we have you here today. Thank you very much for your time.
Thank you.
So there was a lot of talking about a possible Mar-a-Lago agreement in the past, where the US would try to weaken the US dollar to bring back industrial jobs and issue very long-term debt. Now we can see the US dollar is already falling. It has its biggest drop since 40 years from the beginning of the year. Do you think there is more to come? And what do you think does it mean for foreign capital?
Yeah, that's a very good question, but maybe if we can take 1 minute to summarize what is the Mar-a-Lago Accords. This year is the 50 years anniversary of the Plaza Accords, which was a plan by the big leaders to agree on devaluing the dollar at the time. It didn't work, by the way, but at least they tried. And this year, we could have the same kind of agreements, and the deal is the following. So basically, the US is saying to his friends, we have the biggest army in the world, so we can continue to provide you with, let's say, our backing in case of troubles. And we have seen, some of it recently. That's point number one. And point number two, we have the biggest consumer market in the world. So if you are nice with us, we can allow you to tap into these markets. So that these are the two, let's say, gifts from the U.S. administration. But obviously, they are requiring something else, in exchange of this. So the U.S. is going to say we would like ideally to, enhance our U.S. manufacturing. So that's the kind of, let's say, reshoring plan. And also, we might ask you to swap some of the US Treasury debt to something which is very long, because obviously, we have a lot of debt and we need a bit of leeway on that. And three, very importantly, we want a weaker dollar. And there are two tools to achieve that. Tariffs, I think that has been a big theme in the first half of the year. And the other one is potentially a sovereign US funds, where the goal here will be a bit like we do in Switzerland with the SNB, is that the US will buy some foreign currencies and also some neutral currencies to weaken the dollar. So the foreign currencies, it can be euro, sterling, Japanese yen, and the neutral currencies could be gold. This is why they did this audit of Fort Knox. And why not Bitcoin? This is why they are talking about this Bitcoin reserve. So the plan of the US is to say, first, coming back to the dollar, there are some fundamentals which are not great for the dollar. Ever rising debts, budget deficits, higher inflation than in other developed countries. So that's enough to put downward pressure on let's say, a currency which is anyway overvalued by many metrics. But definitely the willingness of the US administration to push down the dollar is weighing on the dollar, and means that we might see even lower level of the dollar. There might be more downside for the dollar. The view they have is that the dollar is too strong because it is seen as the, let's say, the reserve assets by many central banks. And this is why it's overvalued. So they would like to see, let's say, the dollar not being considered as such. And this is why, they have this interest also for neutral currencies. However, they are very happy with the fact that the dollar is the main mean of payments. They don't like to see, for instance, the UAE to trade oil with Indians in rupiah, or let's say Saudi selling its oil to China and renminbi. They want the dollar to remain the main mean of payments. But again, they would like to see a weaker dollar in order for the trade balance to improve. So let's say more downward pressure on the dollar is possible.
Okay, that's very interesting. Thank you very much for your statement. And you already talked about the word reshoring, right? Meaning moving factories back home. I want to concentrate more on my own needs as a country. And we see that happening in all parts of the world. That's the quite opposite of globalization, right? Meaning deglobalization, maybe. What does it mean for global growth and especially inflation?
I think this is, well, it's a key point, and this is not new because I think that two key events happened at the start of the decade. So we had COVID, and then we have Russia-Ukraine. And this has created what we call the East-West divide and also the globalization, in the sense that you still have globalization, but when you are, let's say, a company or government, you know that the world is becoming more uncertain. And that means that you want to control your supply chain in a different way than you used to do. So to do that, there are different things you can put in place. You can do what is called nearshoring. So if you offshore, you do that close to your border. Think about Mexico, Canada, for instance, for the US. You can do friendshoring. So that's why, for instance, the Apple manufacturing is moving from China to India because India is more a friend to the US than China. But you can also do reshoring. And this has already been happening under Biden. Remember the CHIPS Act or the Inflation Reduction Act. They were there, they were in place to make sure that manufacturing is coming back to the US, which means potentially more employment, also less issues with transportation in case of, for instance, some straits got blocked. Think about the Strait of Hormuz or let's say the Strait of Taiwan. You never know. So that has been something in place again under Biden, but which is likely to continue. And back to your question about what is the impact on inflation, obviously there is impact on inflation. Why is that? Because if you reshore, your cost of production is obviously picking up. And also there is these habits of in terms of inventory management and supply chain which has now been in place for years, which is we have been moving from just-in-time inventory, which was, okay, I need more inventory. So I call my manufacturing in China and they're going to send me straight, right now, some stuff. Now you cannot do that because of reshoring. So, you do not, let's say, just-in-time inventory, but just in case, which means that you need to have, let's say, more inventory at hands. And if you remember accounting 101, when you do these let's say when you have more inventory at hands, that means that you have a higher cost, and the cost you pass it through consumers, which means higher prices for goods. So that's indeed inflationary, and this is why we are not seeing hyperinflation or inflation moving back to level of 2022, but we think that inflation can stay structurally higher for some time.
Yeah, that's interesting. And I think so too. So we all have to prepare for a more sticky inflation and an inflationary time ahead. Thank you for your statement. Let's have a look at ourselves. Basically, we are all based, you and myself, here in Europe. And we do have a lot of big challenges here, right? We have expensive energy, especially myself here in Germany. We have very strict regulation. It's very hard to set something up. And we have also the dependency when it comes to defending ourselves to the US. What do you think Europe can do to stay more competitive, to be more attractive, especially for foreign capital, also for the stock market and for companies to move here? What can Europe do in this situation?
Well, first, one issue in Europe is I think that there are different, let's say, currently headwinds for Europe. One is probably overregulation. I think entrepreneurs are really struggling with this, is that it's too regulated, which means that, let's say, the ease of doing business is quite difficult compared to other regions in the world. That's point number one. Point number two, the cost, the access to energy and the cost of electricity. It's at the end, if you look at the economy, is you take input, you use energy, and then you have output. If your energy price is twice the price of the US, for instance, you have an issue. So, it was great to think about renewables and energy transition, but the reality is that, especially since the invasion of Ukraine by Russians, in Europe, we have an issue with the access to energy, which is not the case of the US, for instance, which is a net exporter of oil, the biggest oil producer, the biggest LNG exporter in the world. So they don't have this issue. So that's indeed quite an issue. And then, innovation. I think there are great, engineers, scientifics. Europe is full of ideas, has been on the forefront of so many technological developments, but currently we lag in Europe in AI, for instance. For the timing, it's a two horses race, between US and China. We are lagging, by a huge margin in terms of AI patents, for instance. I think there was a wake-up call in the first half of this year in Europe, generally speaking. It started with Germany, with let's say the defense spending, but also more infrastructure spending. Defense spending is important because when you want to be, let's say, effective in defense, you also need to innovate, especially in the technological front. So there will be, I think, some ripple effects on this. It's not just, let's say, a mathematical increase of GDP growth, but there will be also some, let's say, secondary effects which are likely to be positive. But on AI, for instance, we need to do something. I know the good thing is that we can see coming from the EU, there are no big subsidies for, young companies launching projects on AI. They get, let's say, a lot of help to expand. So potentially, we could see some positive consequences of this in the years to come. But definitely, we lag. So I think, again, it's less regulation, more innovation, and solve this, let's say, electric grid issue, because that's very important. And then, I hope that the strong euro is not going to also weigh on the productivity and let's say the growth outlook for the European economy, because while the dollar is weakening and helping some U.S. exporters, the strong euro is putting pressure on some of the German exporters or European exporters.
Yep. No, I totally agree on that. And now we talked a lot of about the things that are happening in the world, what could be up next, right? And as we said in the beginning, you have to connect the dots to understand and to try to navigate through the stock market. And now we can see that stocks and bonds, they don't invert anymore. They are basically moving in the same direction, if you like. Unlike gold, gold is trying to be the diversifier here. What do you think, all the things that are happening, and from your perspective in the future, what is a good shift for the modern day portfolio? How can I set up my portfolio in an environment like this?
Yeah, well, that's let's say the $1 million question. Several dimensions here. So first, I think anyone need to take a step back and think about what is the world we're currently living in. This is a world with ever rising debts from a government perspective, not just in the US. We talk about spending in Europe, so debt is going to increase in Europe for the first time ever. This quarter we have world debts crossing $300 trillion for the first time ever. US debt crossed $37 trillion for the first time ever. Italy debts crossed $3 trillion. So it's a worldwide game. It's debt is moving up, and that means that government, they have no other choice to focus on nominal growth instead of real GDP growth, and they need to monetize that. So when you think about debt monetization, you need to think about also money debasements and the loss of purchasing power. This has been in place for decades now, which means that as a saver, as an investor, if you take the long view, you need to preserve the purchasing power of your assets, and staying in cash or in low risk bonds is not going to help you. Maybe you will sleep well at night because you don't see much volatility, but over the long run, you're going to lose your purchasing power. That means that you have three ways to deal with this. First, you spend now because at least the price of goods and services is lower than it will be in the future. But that's not, let's say, what savings investing is about. So you can invest into store values. So gold is one way to do it. Maybe the other precious metals look interesting as well. Look at the market action of silver, platinum, palladium recently. And obviously, Bitcoin could be one way also to, add some store values to your portfolio. And then obviously risk assets. So risk assets or real assets are ways to protect your purchasing power. So you can think about real estate. Real estate remains strong, in many places in the world, because it's a nice way to protect against inflation. And then obviously stocks, because stocks, if nominal growth is high, that means that top line growth will be high and stocks will benefit. So you need to have that kind of diversified portfolio where you have stocks, some store values, and then comes, your question about diversification. I must say that long duration bonds are less and less a diversifier in the portfolio, um, because we are in this new regime of structurally high inflation, which means, let's say, higher correlation between treasury bonds and equities, or at least higher correlation than before. And we have seen this recently. It's remember when there was the attack of the U.S. on Iranian nuclear facilities. Bond yields, long-term bond yields moved up. We haven't seen this before. It's they are not that helpful as a diversifier. So I think that on the bond side and fixed income side, the leverage is definitely with the government, not with companies. So this is why we have been favoring high quality bonds till now, but issued by corporates, high quality corporates, instead of governments. So this is why structurally, let's say, allocation to bonds, to sovereign bonds, at least, has been lower than in the past, and we have higher allocation to alternatives, including gold, including hedge funds, including for clients who are open to it, more illiquids, like private equity, for instance, or let's say some private debt strategies. So I think that's the portfolio management 2.0, which is coming. It's not that the 60/40 is dead. Actually the 60/40 portfolio, 60% equities, 40% bonds, has been doing reasonably well in 2023, 2024, and the first half of 2025. But definitely, there needs to be some changes in terms of strategic asset allocation to take into account all of the developments we have been talking about in the last 20 minutes.
And all the things that we talked about, thank you very much for your statement there, by the way. All the things we talked about sounds like there's volatility ahead. But if we have a look at the volatility index, the VIX, it has come back quite sharply. Do you think that's the calm before the storm, if you like? Do you think we will see more volatile times ahead, maybe in 2025, going towards the end of this year?
When there is macro volatility, geopolitical volatility, it's normal to see financial market volatility. So although the VIX is coming back because we are back to new all-time high on the Nasdaq 100, for instance, so that's normal to see VIX coming down if markets are going up. It has not been a very quiet first half of the year. I think it has been quite shaky, and we think that it will remain shaky going forward. But that's, it's normal. It's I think the low volatility of 2024 was an exception. So we will see some volatility, which is good because that's means that you have opportunities to add risk assets at a lower price. I think, however, one lesson also from the first half is that, there was some criticism about in the US, okay, Mr. Trump has too many power in his hands, and it's a one-man show, and that's dangerous for democracy, that's dangerous for growth. At the end, there is free market capitalism is not just about free markets. Capitalism is also about a kind of hidden democracy, which is forcing leaders, including leaders like Mr. Trump, to take into account some pragmatic developments. And I think that a tipping point during the first half of the year was when bond yields started to move too high. That was threatening, financial stability in the US, and this has forced his hands to come backwards on some of the announcement, and this has, let's say, helped to decrease volatility in a considerable way. So I think this is a kind of, let's say, natural stabilizer for markets. The fact that government needs to take into account what the markets are telling them, and this is why there is so much impact of financial markets on the economy that if things turn too nasty, there is this natural tendency of financial markets to dictate to leaders what they need to do. And this is what probably can prevent, let's say, the big crash to happen. But you never know. Crashes are part of capitalism and they are part of financial history. That can always happen. But again, I think if there is, let's say, a lesson to take from to grab from the first half is the impact of markets on let's say on politics and on the economy.
Thank you very much. I think there is an interesting time ahead and a lot of opportunities, a lot of problems maybe too. And I think I wish everybody good luck in investing in the stock market and especially for us and to stay healthy, right? Thank you very much for your time. It was great having you and it was great getting your insights. Thank you.
Thank you so much. Thank you. Bye-bye. Bye.